Most people think the biggest force in finance has to look dramatic. They think it has to be a crash, a war, an election, a bubble, a genius founder, a new technology, a central bank chairman walking to a podium while cameras click. That is how the public imagines power loud, visible, easy to point at. But the greatest forces in money are often the least theatrical. They sit quietly underneath everything else, setting the terms, shaping the choices, deciding what is easy, what is hard, what gets funded, what gets postponed, which businesses feel intelligent, which ones feel foolish, which assets look irresistible, which dreams never quite become financeable. If you do not understand that, you can spend your whole life reacting to symptoms while never understanding the disease. And one of the clearest examples of that is the bond market. If you do not understand bonds, you do not fully understand money. That sentence may sound too broad to some people, but I mean it quite literally. There is one simple number in finance that touches almost everything you care about. It reaches into mortgages. It reaches into stock valuations. It reaches into entrepreneurship. It reaches into hiring. It reaches into layoffs. It reaches into what consumers buy, what they postpone, what lenders demand, what investors tolerate, what companies can get away with, and what kind of return anybody must offer if they want your money. That number is the risk-free rate in practical life. People often encounter it through government bond yields. A bond is not mystical. A bond is a loan. You lend money to the government. The government promises to pay you a fixed rate and then return your principal at maturity. And because the government, at least in the American case, sits at the center of the system that taxes and issues currency, those bonds are treated as the baseline, the closest thing to default-free money the financial world uses as a reference point. That reference point matters because money is never priced in a vacuum. If a person can earn 5% doing almost nothing with negligible credit risk, then every riskier use of capital has to beat that hurdle in some meaningful way. Otherwise, why bother? Why take operating risk? Why take customer risk? Why take labor risk? Why take credit risk? Why tie up your capital in a business that can go wrong in 10 different ways when the government will hand you a respectable return for patience and paperwork? This is the thing most people miss. Bonds are not just one asset class among many. They are the gravity field for money. When yields are low, money becomes restless. It starts floating. It looks for yield, it reaches, it finances dreams, it supports valuations, it excuses optimism. When yields are high, money becomes stricter. It asks harder questions. It requires better deals. It stops pretending mediocre opportunities are attractive. It begins sorting wants from needs, fantasies from cash flows, hopeful plans from durable enterprises. That is why the bond yield matters so much more than the average person realizes. It is not a piece of trivia for economists. It is the baseline that decides how hard the rest of the world has to work to deserve capital. Once you understand that, you start seeing things differently. You stop asking only whether a business is profitable. You start asking whether the returns justify the risk relative to what can be earned almost passively elsewhere. You stop asking only whether a stock sounds exciting. You start asking whether the price implies a return meaningfully above the risk-free alternative. You stop asking only whether an expansion plan is possible. You start asking whether the capital required for that expansion is being deployed at a return that actually deserves to exist in a world where money itself already pays something respectable. This is where I think a great many people become confused. They hear terms like risk-free rate and bond yield and assume we are talking about abstractions too far away from daily life to matter. Not so. If you are a household with a mortgage, it matters. If you run a business that relies on finance purchases by your customers, it matters. If you want to buy a business, it matters. If you invest in stocks, it matters. If you allocate capital in any form at all, it matters. Let me make this as plain as I can. Imagine a small business owner selling something essential but expensive. Air conditioners, industrial filters, roofing work, equipment replacement. A lot of those sales depend not merely on whether the customer likes the product, but on whether the customer can afford the financing. When rates are low, more future cash flow can be pulled into the present. People say yes more easily. A $10,000 project feels manageable because the monthly payment behaves. When rates are high, that same project suddenly feels heavier, even if the sticker price never changed. The product did not become worse. The money did. That difference can separate a year of smooth growth from a year of thin demand. So the business owner who understands the price of money becomes much more realistic. He stops thinking only in terms of product quality. He starts thinking in terms of the financial climate, his customer and habits. If rates are high, wants get postponed first. Beauty products, luxury add-ons, aesthetic upgrades, all the things a household can defer without immediate pain. Needs behave differently. The roof leak still leaks, the furnace still breaks, the air system still fails in summer. But even then, the spending pattern changes. When money gets tight, people do not stop caring about maintenance. They stop wanting large finance commitments unless the pain of not acting is worse. That creates a tremendous opportunity for the business owner who sees clearly. He shifts toward protecting what people already own. Smaller fixes. Maintenance products that extend life, offers that prevent a larger expense later. When money is expensive, customers value preservation more than ambition. A $50 filter that extends the life of a costly unit can become easier to sell than a full replacement financed at an ugly rate. That is not only a sales insight, it is a bond market insight translated into ordinary business life. Most people never make that translation. They sit in a high-rate environment wondering why old sales behavior has disappeared, as if demand simply became irrational. Demand did not become irrational. The cost of money changed. And money changing price changes human behavior. Now take the idea one step farther. Suppose you have the opportunity to buy a small business. You understand the business well, you know how to improve it. You can probably make it work. This, they say, I can fix it. I understand it. I hate seeing it decay. Good. Perhaps all of that is true. Now ask the adult question, what return will this produce relative to the risk-free rate? That is how capital should be judged. Suppose the business might earn you 10% with real effort, real distraction, real operational risk, and real uncertainty. If the risk-free rate is 5%, the true extra reward is not 10. The true extra reward is the spread over 5, and that spread must compensate you for all the stress, illiquidity, opportunity cost, and execution risk the business will impose on your life. Once you see it that way, many emotionally appealing deals stop looking so wonderful. And that is a gift. The bond market protects you not only by offering an alternative return, it protects you by forcing honesty. It asks, is this business merely profitable, or is it sufficiently profitable to deserve capital in a world where money itself has a benchmark price? That is a very different question. A lot of mediocre business decisions get made because people compare an opportunity only. That is the wrong comparison. The right comparison is doing something else with nearly no risk. The difference between those two comparisons can change an entire life. I have watched capable operators buy businesses they understood very well and still end up disappointed because their understanding of the operation exceeded their understanding of the hurdle rate. They knew the company. They did not fully respect the climate. That is why the bond market is such a useful teacher. It keeps asking the same rude question. Why should your idea be funded instead of the baseline? Most people hate being asked that. They would rather be encouraged. Encouragement is cheap. Capital is not. The higher the risk-free rate goes, the less patient the world becomes with pretty stories. That is healthy. It is uncomfortable, but it is healthy. Cheap money flatters weak judgment. It makes bad investments look temporarily plausible because the hurdle is too low. It lets the owner confuse movement with return. Then rates rise and the honesty returns. Suddenly the business that made sense only because money was nearly free no longer makes sense. Was the business ruined? Not necessarily. It may simply have been misjudged all along because the investor never asked the right baseline question. Now let me tell you where many business owners make a fatal mistake. They think profit is the objective measure of success. Profit matters. I would never say otherwise. But profit alone can flatter a weak business. A business can report profit and still be quietly starving. How? Because growth consumes cash. This is something far too many people learn too late. Suppose I spend $500,000 to create inventory, acquire customers, build working capital, do the marketing, and support the sales needed to produce $1 million in revenue. Suppose after all the expenses I make $300,000 in accounting profit. That sounds healthy. But if doubling the business next year requires another large investment in inventory, working capital, staff, systems, and marketing, then the business may actually be cash hungry, even while it looks profitable. Profit says one thing, cash flow says another, and in business, cash flow usually tells the harsher truth. A business that grows but continuously consumes all the cash it produces may keep flattering the owner with activity while leaving him dependent on outside capital, refinancing, or constant reinvestment just to stay alive. That is not compounding. That is treadmill economics. The owner feels busy and important while the machine keeps demanding more fuel. This is why I care so much about return on capital. If you want to build real wealth, you do not merely need earnings. You need the ability to take $1 of retained cash and turn it into more than $1 of value at a rate that comfortably exceeds the bond market over a long period. That is where fortunes are made, not simply by being profitable, by being able to compound capital at high rates repeatedly. A business that earns decent profits but must consume enormous fresh capital to grow may create jobs, headlines, and excitement. It may not create owners rich enough to matter. A business that is capital light behaves differently. This is one of the most underappreciated distinctions in all of business. If every extra dollar of growth requires another dollar of capital, you are shackled. If you can build something once and sell it many times, or if the marginal cost of serving additional customers remains low relative to the price, you have something much more powerful. Software is the obvious modern example because the economics are so dramatic. You spend heavily once on the code, the team, the system, and then additional customers arrive at relatively low marginal cost. But the deeper lesson is not about software specifically. The deeper lesson is about replicability, knowledge that can be packaged, systems that can be reused, brands that reduce selling friction, processes that can be repeated without equivalent new capital each time. This is what capital-light businesses have in common. They separate growth from heavy reinvestment, and that separation is how they produce extraordinary returns on capital. If you can build once and sell repeatedly, then the business has a chance to outrun the bond market by a wide and durable margin. If each new sale requires roughly proportional new capital, the spread over the risk-free rate gets much harder to maintain. That is why I tell people to stop idolizing top-line growth for its own sake. Growth is not sacred. The quality of growth is what matters. Growth funded by endless capital demands can make a business look ambitious, while leaving the owner no richer in proportion to the effort and risk involved. Growth with high returns on incremental capital is entirely different. That is where compounding begins to look magical from the outside. Now, if you want to understand why some businesses reliably beat bonds over decades, while most do not, I would give you 4 filters. They are not fashionable. They are not complicated. But they are effective. The first is a moat. The risk-free rate has no competition problem. It simply exists. If you want capital to choose you over bonds, you must have something that makes attack difficult. A brand, a geographic advantage, a relationship network, a proprietary process, a cost position, a trusted reputation, some real protection. Without that, competition will eventually eat the return down toward mediocrity. Mediocrity cannot sustainably outrun the bond market after enough time and enough rivalry. The second is pricing power. If costs rise and you cannot raise prices without losing the customer, you have a weak business no matter how exciting the story around it may sound. Pricing power means the customer values what you provide enough that the business can preserve margin when the world becomes more expensive. That matters tremendously in inflationary periods and in any environment where capital must justify itself against safer alternatives. A business without pricing power is always more fragile than its admirers think. The third filter is low capital intensity. I have already spoken about this, but it deserves repeating because people consistently underestimate it. A business that must constantly shovel capital back into itself to stand still is not nearly as attractive as one that can turn modest reinvestment into large growth. The market has a bad habit of rewarding stories and under-rewarding capital efficiency until the arithmetic finally reasserts itself. I prefer arithmetic early. The fourth is disciplined capital allocation. You can have a great moat, good pricing power, and low capital intensity, and still squander the whole advantage if management deploys cash stupidly, overpaying for acquisitions, buying back stock at foolish prices, chasing vanity projects, underinvesting in the core, over-leveraging at the wrong time. Capital allocation is where management's true character appears. The owners do not ultimately get rich from reported income alone. They get rich from what happens to retained earnings. If retained earnings are squandered, the owners are being robbed politely. So these 4 filters matter: moat, pricing power, low capital intensity, disciplined capital allocation. Together they answer a deeper question: why should anyone choose this business over the bond market? Not in one hot year, over time. That is the question worth asking. Now let me say something that may sound odd coming from a man associated with stocks. Before many people need to learn entrepreneurship, they need to understand bonds. That is because every business owner is really an investor first, whether he admits it or not. His job is to allocate capital. His time is capital. His money is capital. His team's effort is capital. His retained earnings are capital. His reputation, distribution, brand, and operational attention are all forms of capital. And if he cannot earn an adequate return on those resources relative to safer alternatives, then he is not building wealth. He is consuming opportunity. That is a hard sentence. It is also one of the most useful sentences in business. If your business cannot reliably produce returns above the risk-free rate by a healthy margin, then you do not have a wonderful business. Regardless of how hard you work, you may have a job with overhead that is very different. I do not say this to discourage people. I say it because honesty is useful and false encouragement is expensive. A business should be judged against the price of money, not merely against the owner's appetite for effort. Now, if you want to become genuinely wealthy, not just visibly busy, there is another leap you must make. You must stop thinking the secret is working harder. The real secret is building something that can be sold repeatedly without proportional new effort or capital each time. The world calls this many things: systems, licensing, software, franchising, brand leverage, distribution, leverage, process leverage. The name matters less than the principle. Sell many times if your economics improve as you scale because the cost of the next unit of revenue is much lower than the last, then you are approaching something the bond market cannot offer. True compounding at a high rate. That is what the wealthy are really chasing, not activity compounding structures. This is also why so many ordinary small businesses remain ordinary. They are worthy. They may serve real needs, but the owner confuses labor substitution with capital compounding. He thinks every extra hour proves the business is working. What matters is whether the business produces increasing returns on the capital and time committed to it. If it does not, then the business may still provide a living, but it is not yet the kind of machine that outruns risk-free money by enough to create extraordinary wealth. That does not mean you should quit. It means you should look for the leverage point. Can the knowledge be productized? Can the process be standardized? Can the distribution be widened? Can the customer acquisition become more efficient? Can the sales engine become less dependent on one human being's continued exhaustion? These are the real questions. The bond market teaches discipline because it keeps asking the same blunt thing. Why is your use of capital worth the risk? That is a useful adversary. It protects you from sentimentality. It protects you from vanity. It protects you from saying yes to opportunities merely because they are available or because they flatter your self-image as an entrepreneur. You do not need more opportunities. You need better spreads over the risk-free alternative. That is the adult version of ambition. Now, I want to say one final thing because it matters deeply for households as well as for businesses. High bond yields change not only what business owners should do, they change what ordinary people buy, defer, and fear. When the safe rate is high, saving becomes more rewarding and spending becomes more selective. People hold cash differently. Lenders behave differently. Employers invest differently. What feels like a mysterious slowdown in demand is often just the price of money becoming more honest. And when the price of money becomes more honest, all the sloppy assumptions built during easy money years get exposed. That is not cruelty. That is reality restoring order. So if the world feels tighter, less forgiving, more selective, and harder to impress with weak ideas, do not begin by asking which politician caused it. Begin by asking what the price of money is and whether your household, your portfolio, or your business has economics strong enough to deserve capital in that world. That is the better question. It is a much more useful question than asking what headline is trending. The public is always looking at the noisiest object in the room. I prefer to look at the load-bearing one. And in finance, one of the most load-bearing objects in the entire system is still the boring government bond yield. It tells you what cash can earn without drama. It tells you how hard every other asset must work to deserve your money. It tells you whether consumers will stretch or retreat. It tells you whether growth is being subsidized by cheap capital or earned through real economics. It tells you whether your business is truly compounding capital or merely staying busy while money had nowhere else to go. That is why I say if you do not understand bonds, you do not understand money. Not because bonds are glamorous, because they are foundational. And foundations do not need to be glamorous to decide what the whole building can support. Most people spend their lives staring at the paint. I would rather know what is carrying the weight. That is how I think about money. That is how I think about business. And that is how I would suggest you think too if you want to build something strong enough to deserve capital in any climate. Not just the easy ones, but there is one more layer to this, and because they never reach it, they continue making choices as if the risk-free rate were merely an academic concept rather than the central judge of economic seriousness. The risk-free rate does not only price businesses, it prices your patience, it prices your discipline, it prices your willingness to delay consumption. It exposes whether you are building a machine or simply running faster on a treadmill. When rates are low, weak operators can hide, households can overborrow and still feel sophisticated. Speculative investors can mistake momentum for genius. Managers can take on foolish projects and still look competent because capital itself is too cheap to punish them quickly. When rates are higher, the masks come off. Now the household with no buffer feels the pressure. Now the business selling wants rather than needs discovers the customer does in fact discriminate. Now the acquisition that looked romantic must justify itself against a real alternative. Now the owner who was celebrating accounting profit learns that cash hunger is a much uglier truth. This is why I think the bond market is morally clarifying in a strange way. It does not flatter, it does not applaud. It simply raises the hurdle and asks, who really deserves capital? A lot of people hate that question because it forces them to confront what their operation actually is. Perhaps it is not a compounding machine. Perhaps it is a decent livelihood with low returns on capital. Nothing shameful in that. But it is a different animal. Perhaps it is a good business trapped inside a bad structure. Perhaps it has attractive margins but poor capital allocation. Perhaps it has happy customers but no moat at all. Perhaps it has growth but the wrong kind of growth, the sort that demands fresh capital every time it wants to look successful again. The risk-free rate does not merely tell you the price of money. It tells you the honesty of your own economics. That is why I would rather understand it than gossip about the latest market obsession. If I were teaching a young person how to think clearly about money, I would begin there. I would tell him that every time he sees a number in finance, a valuation multiple, a cap rate, a mortgage rate, a private business offer, a stock market enthusiasm, he should ask the same question: compared with what? Compared with what a completely safe instrument yields, compared with what risk must now be paid to deserve attention, compared with what else this dollar could do while I sleep. That habit alone would save him from a great many errors. He would buy fewer stories. He would make fewer emotionally flattering acquisitions. He would stop confusing motion with return. He would stop thinking the presence of profit automatically means the presence of value creation. He would become harder to sell to. That is always a good beginning. And for people already in business, I would tell them to do something even more important. Use the bond yield as a constant reference point, not to discourage yourself, but to sharpen your ambition. If the risk-free rate is high, do not complain that the world is unfair. Ask whether your offer can move closer to needs, closer to protection, closer to lower ticket decisions, closer to recurring demand, closer to the sort of necessity that customers still buy under pressure. Ask whether your growth is funded by real cash generation or by hidden future demands on capital. Ask whether your model contains real leverage through systems, brand process, knowledge, or distribution, or whether it is still just a heroic amount of labor wrapped in entrepreneurial language. Ask whether your capital allocation is so disciplined that every retained dollar has a clear purpose and a superior expected return. That is the right response. Not self-pity, not macro-obsession, not pretending the bond market is a side issue. When the hurdle rises, your job is not to complain about the hurdle. Your job is to become good enough to clear it. That is business. That is investing. That is maturity. There is one final misunderstanding I should clear away when I say bonds matter. I am not saying the answer for everyone is to hide in bonds forever. That would be foolish too. The point is not that risk-free returns replace enterprise. The point is that they discipline enterprise. The bond market is the measuring stick that tells you whether your risk-taking deserves to exist. A wonderful business can beat bonds by a mile for decades. That is why I love wonderful businesses. But I love them precisely because I judge them against the discipline of the baseline. Without a baseline, enthusiasm becomes sloppy. With a baseline, quality becomes visible. So yes, build, yes, invest, yes, take intelligent risk. But do it with the full knowledge that capital always has alternatives. And one of those alternatives is the government bond yield quietly sitting in the background, asking whether your idea, your business, your valuation, your expansion, your deal, or your portfolio truly deserves to outrun it. That is the right judge, not fashion, not applause, not busyness, not the volume of your confidence, just the spread between what can be earned safely and what you think can be earned through risk. If that spread is wide, durable, and supported by sound economics, then you may have something real. If it is thin, fragile, and dependent on continued good weather, you may simply be operating in a story that cheap money allowed you to mistake for strength. I would rather know the difference early, that preferences save me more money than a great many hot ideas ever made, and it can do the same for you if you let the boring number do its quiet work on your mind. The boring number is often the most important one. That is why I keep returning to it. The market can keep its noise. I want the foundation. And the bond market is still one of the clearest foundations we have for understanding what money costs, what risk should earn, and what kind of enterprise really deserves to grow. Once you understand that, finance stops looking like a circus and starts looking like engineering. That is a far better way to live with money.